Good morning, everyone. Welcome back to the Schwab YouTube coaching channel for the Thursday edition of Trader Talk in today's market. This, of course, happening. I am your host, Kevin Horner, and I'm joining you from Chicago, Illinois. Pleased to be working out of the Schwab studios here in Chicago this week. It's been a busy week, of course. We've got plenty of market commentary, market headlines, and obviously an FOMC rate decision yesterday that did not really move things in the marketplace, at least not in terms of expectations. But of course, the commentary did seem to have an impact on the market, and we're going to talk a little bit about that with all of you today. Now, I am running solo on a Thursday as usual, but I am very pleased to be joined by my friend and fellow Schwab coach, Barb Armstrong, there in the chat. Say hey to Barb. Make sure you're nice to Barb. She's fantastic. Wonderful coach, a good friend. I'm glad to have her joining us this morning. You can follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS. It's a great spot to find us when we're not hosting classes for you here on the channel. Now, we're going to move into disclosures so that we can get down to the business of the charts with you all this morning. So let's run through those briefly. Please remember that everything we cover today should be considered informational and educational only. We do not make recommendations. We do not endorse any specific approach to trading the market. What we offer you here in the way of our review of the market is some concepts and strategies of technical analysis that traders might choose to employ. So we'll look at the various indices, sectors, stocks in the news, etc. And as we do that, we employ technical analysis concepts. And so those concepts can be taken and utilized by you. You can flesh them out yourself. You can customize these concepts to your liking, of course. That's really what we encourage, is that you build a plan and a process consistent with your comfort for trading the market, and both in familiarity of how prices act and move, but also in risk management, a very important aspect to bear in mind as well. So everything we cover in the way of technical analysis should just be considered one of your decision-making puzzle pieces, and we discourage you from using technicals as the only means of your research. Now, in this class, we take generally speaking, a top-down approach. What that means is we will start broadly with our indice groups. We'll work into some industries, sectors, etc., that are moving around. And I like to wrap the day in this class with a review of stocks in the news. Now, we do also have one single position that we've kind of been managing a little bit in this class on Thursdays. And we'll look at that one position. As of the open, at least, we still maintained that one position, so we'll see to what extent that stock has held within our portfolio, and see if we're still managing it, still hoping to manage it, that is, hold it for as long as possible. So with that, let us take a look at the S&P 500 here, everybody. So I'm going to bring that in. So yesterday, like I said, we had this pretty ugly candle, right? Looks like we've got rejected at our downtrend line, and we basically used the Fed commentary out of Mr. Warsh to sell down the market a little bit. And that selling more or less tied to the commentary that Mr. Warsh shared. So a couple of the key pieces there were in regard to thoughts about potentially not just necessarily holding steady, but actually possibly raising rates between now and the end of the year. That commentary certainly led to the selling we've seen. So after the two-day meeting here, what we heard was maintaining rates at their level, right? Target range of 3.5 to 3.75%, but they see rates increasing in 2026 according to the summary of projections. The Fed funds rate median estimate now for the year end stands at 3.8%, and that's an increase from the 3.4% that were in the prior projections for March. So that does suggest that the committee sees the potential of one rate hike as a necessity in 2026. Now, Warsh revealed additionally that he abstained from submitting any projections, which does kind of muddy the waters a little bit on the forecast. Traders are focused on the way that he several times in the press conference emphasized the Fed's commitment to what was deemed price stability, which could be considered a signal that he may not follow through with a push to lower rates as was kind of expected. I mean, everybody with the belief that this was the president's nominee, of course, expectations were that he would be as dovish as the president is. And yesterday's commentary kind of suggested that may not be the case. Now, whether we follow through with that commentary, it definitely remains to be seen, of course. So plenty to try and parse from yesterday. But if we're simply looking at this from the standpoint of price action, well, we can do that on a shorter term basis because, yesterday's action brought us back below the 20-day at the close. Yes, we've gapped above the 20 on the open here, but we need to take a look at some intra-period support resistance levels so that we've got a better picture of where we might need to be paying attention. So here is a clear example of it, right? This is the hourly chart on the SPX. There was our peak, and we rallied back nicely and failed at the downtrend line. So here's what we need to make sure we're paying attention to today. Do we get any price action that gets us back up above this downtrend that exists from Monday's gap? So let's take a look. This is the line I'm talking about. So we've rallied into it with today's open, as you can see, but that's all we've done. We haven't broken that. And so now many a trader is going to look at this as what it is. We've got highs, and then we, of course, have lower highs. Okay, so we have a lower high here, and we made a low that basically filled in the gap. Okay, so if you're feeling like the market is going to go bearishly here in the S&P specifically, some traders are going to be looking to target possibly the lows we made yesterday. But because we are in a lower high scenario short run here, some traders might be thinking not only do we make a matching low, which would be 7,400 approximately, but that we could see the lowest low we've had over this last period here down at that 72.50, 72.60. Needless to say, that's not going to feel too fantastic from an SPX standpoint. But where does 72.50 reside on our chart? Well, 72.50 is basically those lows we saw here just a week ago, right? So we've got those June 9, 10, 11 lows. That's ultimately horizontal support. The 50-day comes in at 73.15 today, so we'll monitor that from a trend following standpoint on the daily look at things. But it is a little bit of a disconcerting move, obviously, from the SPX. We could say something similar about the NASDAQ, the Russell, the semis, as we'll see, but ultimately this commentary yesterday may have just thrown a little bit of a wet blanket on things here initially. We'll see. Now, what we're going to see here in the NDX is something similar, except a little bit more exuberance in our tech trade, up 1.5%, back above the 20-day here. The level that we fell to was just the 20-day, and so now we've gapped, and we actually gapped over the high. So this is looking a little bit more constructive, right? Because we've put ourselves potentially above the high of the very brief low day following this gap. So we've filled the gap, traded above yesterday's high already. Now we've faded a second, so let's see how we manage it. But once more, some traders, look at this. We've got this move through gapped R1, okay? And one thing we know about the pivots is that when we gap a pivot level, whether it's R1, S1, etc., we end up creating a different or a new pivot point. Remember what the pivot point is, everyone. That's my purple line here, and it's the estimated to be the price equilibrium for the instrument. So in this case, on the NDX, equilibrium price at about 29,835, based on yesterday's open, high, and low, etc. And now, because was the point around which trading would be expected for the day, because we gapped higher through one of those levels, many traders would tell you that that ledge becomes this ledge. So more or less traders would say, all right, we now need to shift our true pivot point to what is R1. And the thought is this can act as short-term support today. So can we hold R1 in the NDX? It should be noted, yeah, that we took out the downtrend line with the open. So let's just put a little bit of optimism there on the NDX in the hopes that we pop that higher. Now let's take a peek at the Russell. Small caps here up 1.3%. And of course, you would expect with any commentary that rates might be going higher. The Russell did have a pretty good little bit of a bleed through yesterday. We did find the 20-day. We had a big candle. As you can see, our range kind of expanded there. The low of the day, 29.11 approximately, from our high of 29.77. So we saw a pretty wide trade, but we held the 20. Moves below the 20 have been perfectly appropriate to join in below the 20, but testing the 50. And right now, up above, like I said, we gapped the move, but we did not, as of yet, trade higher through the high of yesterday, which would be a significant development for the small cap. So we'll look to see if we get that from them. But the 10-year yield yesterday spiked following all of this, and yet here we are right back to the 50-day today. So yields are back down to 4.43, so you're getting a little bit of lift. Now, could we call this support? We sure could. I mean, you got to look at this horizontal level as support, right? We've been here a number of times over the last 2 months. If you drill into hourly, you can see it even more clearly, right? So this is only the last 20 sessions. If we make it the last 30, just add a little extra, yeah, you can see a move under this 4.4 zone would be fantastic for the Russell, right? Would certainly give us the potential tailwinds to shove the Russell higher. But a bounce from here, any move that gets us back above 4.55, you all know the importance of 4.55. That was, it makes any longer, everybody, it looks to me like this move here is the fake out move right now, right? This one here, look at how it appears. You can see it on the daily, right? So it looks like a bit of an island by itself. And if we take out the 50, take out this low at 4.4, that may very well look like the validation of lower yields going forward. So it's really kind of odd to me because the market is the narrative around the market is worried about yesterday's commentary, and the truth is the traders are positioned defensively based on Mr. Warsh's commentary. Take a look at the Fed tool here, everybody. I'm bringing in the third-party CME Group website. This is not Schwab, third-party specific, and this is not an endorsement for the site, but we utilize this as an understanding of how traders are possibly positioning themselves. And here is the key takeaway. Looking forward in July, the next meeting, July 29, 63% likelihood of holding steady. This is our current rate, but a 36% likelihood of a hike, okay? Now, that in mind, look at where we were a week ago. 8.3% probability of a hike. A month ago, less than 7% probability of a hike. So we are clearly seeing an increase to the risk associated with a potential hike. Doesn't mean it happens, but that's how traders are thinking about it. Now, if we go out further, and instead of going just 1 month at a time here, let's go all the way out to the December period so we can get a picture of year end. Again, we're at 350 to 375, and this is year-end projections, everybody. Year-end steady Eddy suggesting 14%. That is to say, 14% likelihood of no changes between now and the end of the year. Now, a 25 basis point hike, 37%. 50 basis point hike, 34%. 75 basis point potential hike there, 12%. So heads up, okay, this is notable. This is how traders are positioning, and we need to bear that in mind because any of this optimism in the immediate rally could be squashed quite quickly here should things deteriorate further. I think this is very important. We have to pay attention to it. We'll continue to cover expectations of traders relative to the CME Fed tool as we move forward here. But I thought that that was quite pertinent to the discussion today. All right, let's look at our semiconductors up 4.5%. Nice bounce back here. I think the reminder is what we've been saying all along. Semiconductor trade is far from over. Look at how we continue to use the 20-day moving average, everybody. Yes, if we go back to the end of March, the 20-day was violated here for 2 out of 4 sessions, but not sufficient to break the trend as we've moved to new highs yet again. Now, I mean, you can choose to bet against the semiconductors. At some point, a deeper drawdown may very well occur, but you know, one of the things we don't advocate for is counter trend trading necessarily, because it is so risky and difficult to manage. So, you know, trend trading, working with the existing trend, buying at areas of support, selling at areas of resistance, very generically as it applies to any index, any position. That's an approach that most traders are comfortable taking. Here, it would be difficult to be terribly bearish on semiconductors given what we've seen. And there's certainly some of those semiconductor stocks that are moving for you. I saw somebody calling out Intel in here. Intel, yep, see, breaking out. Intel with a little bit of a consolidation pennant. And then once it broke out, we had to pause at the prior highs. We got thrown back to the 20-day moving average, the downtrend line, and then the gap up here today. The president noted that Apple has agreed to work with Intel to design their chips. According to social media posting, that is, quote, the technology the world relies on was invented in America. We all remember, quote, Intel inside, end quote. Stupid presidents took our economy for granted and let Taiwan and others steal our semiconductor factories. End quote. I'll just leave it at that. It looks to me like you're getting some more enthusiasm in the U.S. side of the semiconductor trade specifically. So we'll see if that maintains. But, you know, as always, traders, if you're getting moves you're looking for, make sure you're managing your risk. That's a big part of what we do advocate for, is making sure that we're all employing risk management strategies that allow us to stick with those trades for as long as we possibly can. All right, let's see what else we've got working here. I'm just going to take a quick perusal of our posting. So many familiar names and faces in here. I'm glad you all are here today. All right, so let us take a look at some sector action. Now, one of the moves we got today, additionally, we've seen oil continue its slip. I'm going to use the crude futures here to highlight this, but not advocating for futures trading. Remember, futures trading carries a higher level of risk. It's not appropriate for all of us as investors or traders, and you need to be approved to trade futures at Schwab. What we're doing here is simply looking at the chart to kind of validate price action. And what's notable to me here is the finding of the 200-day with today's price action specifically. Right here at 73.20 a barrel, finding the 200-day. Brent and I yesterday spoke at length about this, specifically the tightening of the spread as it relates to options. Here we go. The future dated options are showing a much closer value than we had seen previous. So noting July at under 74, yeah, we're at 73 right now, but November at 71. And remember, this was quite a bit different of late. It wasn't that long ago that the November contracts were expected to be in the ballpark of 80. So I found that to be kind of notable here as well. So tightening of the oil trade a little bit, and it seems like, now granted, reminder, at some point oil's going to get a bit of a relief bounce after this much selling, because we see that it's basically down from 97 to 73, so it sold off 25% here, everybody. Anticipate a counter trend bounce. I think that would be the expectation that many traders are building for here potentially, but Obviously we wouldn't complain if oil just cratered, right? That would be wonderful as for the inflation story, wonderful for our pocketbooks. But I don't expect it because the market goes down, and when it goes down, it bounces, right? You often get counter trend bounces. So I've got my resistance in consistent with the 20-day moving average. Some traders might look at the 10-day moving average given the speed of the selling here. That's just under 84. But a 10-point bounce in oil, everybody, that's a 15% move. So just bear in mind, you may very well get a so-called relief bounce in oil, which could apply short-term pressure. And as a result, energy is moving lower here today. So let's take a quick peek here. Let's see here. So energy, yeah, look, you took out a pretty healthy area of support right here with this move today. So the energy space appears to be short-term bearish. Of course, we've pushed the RSI under the 30 line, or to the 30 line, I should say. So we're getting into oversold conditions now. But at this point, it seems like the path of least resistance may be at least a test of the 200-day moving average, given the breakaway gap lower we've seen in energy. So maybe a bit of a pause to the enthusiasm of energy. Energy, one of our better performers on a year-to-date basis, as you all know. If we take a look at our Market Watch tab here on the quotes page, energy still number 2 this year in percentage return, right behind tech. So evidently those two can work in hand, right? But I'll remind you, at one point, energy was up 40% on a year-to-date basis. So we get these moves, we get opportunities to join and participate. How we choose to manage that is up to us, of course. But I think it's notable. Let's look at industrials. Industrials are having a good day here and move to new highs. So this is an interesting chart, because if you take the view that this consolidation in here was kind of a long handle, you could call it as such, right? I mean, I might draw it in like so. Here's the left side of my cup. Here's the right side of my cup, and then a very elongated handle. Ultimately, we don't have to be too cute here, do we? We could just draw the line like so, get the distance down to the low, and now we have an approximation of where the space could go. I'll just activate that line and add it to the top. And as you can see, that would be a positive development for industrials from a technical standpoint. Now, of course, when we draw lines like this, measured moves like this, these are not guarantees to be achieved in any way, but of course, that would be a fantastic development if it were. The move would be about 11% to the upside if it were to capture that 1700 level in industrials. So industrials are an improving space. Big move today there, of course, in the tech side. Excuse me here, let me pull this back. Yep, there we go. So we bounced well right back into the 20-day. Some traders love that, hey, you broke the diagonal trend line, so I'm going to be in. Some traders really like that opportunity. Might be a little too tight to know. It's still too early in the day, as you all know, but you're seeing some improvement here to the trend here by getting it right back above the 20. We'll see if that maintains. There's the trend line, but again, here, the trade is back above the R1, so again, same thing we said about the SPX or what have you, gapping R1 gives you a new area for potential short-run support if you wish to utilize these pivot points as an example. So tech kind of getting itself back in gear, and on the short-term trade, kind of giving you the idea that it wants to use today for some optimism. We'll see. We're right at an important level. If we can get tech rallying further, yeah, this could be a nice development for technology here today. All right, and then we're going to look at a couple that you all know we've been watching too. From the sector standpoint, let's look at healthcare and financials. So Here we are out, that's Staples. So we should anticipate Staples maybe moving lower again with regard to the so-called, if we're in a risk-on environment, you all know likelihood is that Staples will struggle a little bit, kind of been in consolidation. The move up is really coincident with the selling in tech. So buying in tech, yes, makes sense that we're seeing some selling in Staples. Let us move down the line. Next up, there we go, is the healthcare. Now, healthcare has spent this last week in retreat mode, but this might be giving opportunity here because we have found some confluence of value here, right? We've got horizontal support. We've got the 200-day moving average right here as well. And the moving averages collectively, the 20, the 50, the 200 are all kind of right on there in this vicinity. You'll notice we've also got a bit of an uptrend line working here too. So a few things for traders to give consideration to in healthcare. Let's do a quick look at biotech in healthcare. Let's see. Yep. So this is U.S. biotech. I'll tell you, that is an interesting look here, everybody, because look at how the so-called, the trend here was so strong working against the 50. Let's just go with just the 50 here for a second, right? 50-day support. Okay, now resistance, but now possibly support again, right? Here we basically, outside of our brief hiccup at the beginning of the month, we've been back above it for a month or so, haven't we? Now, we haven't moved to new highs, so we do have a lower high in biotech, but draw that downtrend line, right? And what do we have is a break of the downtrend line and then a consolidation. Not a terrible development here. Trend-wise, you've got horizontal support. Okay, we made a price action, made a lowest low back here in the end of May, but it was much higher RSI. So we at least, some traders would look at that and say, hey, I've got the confidence that these lows can hold. And so while some traders would build entrance against a 50-day moving average because we're above it, other traders maybe piece out of a chart like this and say, all right, under the 50, I'll have an exit strategy for a portion of any trade. Under the most recent lows, being that that we had a bullish divergence in price, the expectation is to hold this ledge. They might build an exit strategy against that level, approximately 1925 on this index, 19,250 on this index. And utilize that as a means of moving on from any trade, meaning completing the trade. They might piece out a little higher and then move on from the trade in its entirety if we made new short-term lows on a closing basis. So just as an example of a potential process for management. And again, it's not specific to this this pattern as it relates to this index necessarily, because you can't trade this index, of course, but it does give you some insights as to how a trader might manage a trade and manage their own tolerance for risk that way. All right, so there's healthcare, and then financials. Also an area that I wanted to peek in on because there's been some pretty dramatic improvement here of late. And first of all, before we get there, I'm going to mention, I don't know, I'm sure you guys are seeing it. My system lag here today is a little bit frustrating, so I'm going to apologize in advance. But here is what I think stands out for a lot of traders with regard to financials. We broke our downtrend line, gapped above the 50. We had a test of horizontal support. Man, this is so textbook stuff, everybody. Let's zoom into this because, you know, and again, I'm going to mention, very self-serving, that I posted about it when it happened. But the day that we hit this low, and in fact, I think it was even the hour that we got down there, I posted on X about this because I was wondering if this was going to be the break point. I didn't know. It was a good move below the 50-day. And what did we get? But a test. It was a horizontal support test, and that is not a negative, right? That is a positive. The fact that we broke the moving average, the 50-day on that move, but held support to make a matching low, not a lower low, was the positivity we took from that. Now, the next day we gapped up, and we have been higher each day since, essentially, right? So you've got an excellent way for trend management here. Possibly the 50-day moving average, possibly the 20-day moving average, since they're more or less right on top of one another. But again, 200-day, 50-day, 20-day, all in the same vicinity, and we're getting some confirmation with the RSI as it made a new move to highs at the same time that price made a move to highs as well. So we like to see that. We like confirmation from the RSI validating the new high in price. Short term, maybe we anticipate a little bit of a throwback opportunity possibly to join the trend. Remember, what goes up will either pause in the rally, go sideways for days or even weeks. Sometimes the consolidation happens in the form of price, and you'll get a pullback quick, and then that entices and gives traders new opportunity to join in. But the consolidations happen in one of two ways: either price movement quickly to find support, or time passage will be the other way, right? So financials showing some improvement there as well. Now, on the heels of yesterday's commentary out of the Fed, let us see how utilities and real estate are doing, because they're both up today in the face of everything else rallying a little bit today after some selling. So utilities are at an area of support. Now, one of the things for consideration here may not be relative to this space for trades specifically, but maybe specific to investors who are needing to expose money to areas of their portfolio. Remember, if you're taking a long-term asset allocation approach to your investing for any of your portfolios, then chances are you are not worried about what's going on day to day. You're watching the broader trends, the longer term trends. And when you see a space that has retreated to an area of support, whether that's the 200-day moving average or my uptrend line that I've drawn in, you can see that this might be a spot for investors to expose money to a space. Now, it's true that the utilities as a sector, real estate investment trusts as a sector, these are small components. But if your approach is one that has you matching or mirroring an investment model, well, then chances are you need dollars devoted to all 11 of the U.S. sectors at appropriate percentages, right? That is a common approach, and most often that's achieved through the investments in mutual funds and exchange-traded funds in lieu of individual equities. Odds are that you can maintain a long-term portfolio through just those mutual funds and ETFs and have the proper allocation that you're looking for. But instances where you find long-run support become opportunities for exposing money into an investor long-term thought process, long-term portfolio. So I always like to bring that reminder, because not everyone who joins us for Trader Talk, not everyone's a trader, not everyone wants to see this act this way or necessarily act on a day-to-day basis. They might be thinking about things in a little bit more of a long-term basis instead. Okay. So there's a look at, we basically have run through our indices. We've hit on a number of the key sectors here. Let us move on to some of those stocks that are in the news this morning on some headlines. So I'm going to pull up my notes. We talked about Intel a little bit. We noticed that. We've had some stocks get some upgrades. I spoke briefly this week about American Express. American Express was upgraded to buy from hold. Put a new target on this one at 375. This is at DZ Bank. 375 would be a nice 25% premium from where we are. But one of the things that stands out on this chart to me, everybody, is some horizontal resistance that we've moved into. Remember, resistance, doesn't mean that it has to stop rallying, but it shouldn't surprise traders that it's breathing at resistance. And of course, one key component from a technician's approach is to see, can we make a higher low? So if we make any kind of a pullback, we have an opportunity to make a higher low at a number of key areas, don't we? Because look, first of all, we got this ultimate peak up here. And if I drew a line from that vicinity through the lows, or through the peaks there, what we see is that we've broken a bit of a downtrend line. But as long as we don't find ourselves back, in this area, chances are we're looking at a potential opportunity. Really, what a bullish trader in American Express wants to see is only a little bit of a give back, maybe to the gap zone. If you could find support in the gap, whether it be the bottom of the gap or the top of the gap, in that vicinity of 330, that would be about halfway back on the move we've made up. In fact, we could always draw the line there, couldn't we? We could do a little Fibonacci move, because we all know, who doesn't love Fibonacci's, right? Let's just put it here to the peak, and then we see, all right, so there's about right in between the 50% retracement and the 38% retracement. And so maybe that's a zone of possible support. Doesn't have to get there, all right? And even if it does, it doesn't have to hold it. But that's something that a trader might be hoping to see on any pullback from this high, all right? So something for your consideration there. Now, what about Enphase? Enphase was upgraded at Barclays. So let's take a look at ENPH. No, that's not going to work if I include American Express. Let's try it one more time. All right, so Enphase clearly was hot for a minute here, wasn't it? Had a huge rally. Let me make sure, am I still in 1 year? Yes, I am. So we've had a break of the downtrend. I'll change that to a line. All right, and when we broke the downtrend, it exploded up. My goodness, this move was tremendous. Look at that, 84%. What a wonderful pop. So now you've been thrown back to basically the lows that you've seen since the breakout, 50-day moving average. I think a lot of traders would draw horizontal support kind of like this, right around 45.5 or so. And yeah, given what we've seen, you wouldn't want to see it back below the 50-day here. But look at this, couple of things. One, you're getting in the fish hook right now with the RSI. And it's happening at a level that would be considered to be, supportive in nature, under the 50 level, but down to 45, and now fish hooking upward. And that's partially because today you're getting a nice little tail, so weakness this morning. But the other thing, weakness off the open, excuse me. The other thing that stands out is volume. Big volume in the moves to the upside, and then on the pullback, much lighter volume, right? Remember, you can add in average volume, and I encourage it, to be honest, because average volume tells us quite a bit about who is monitoring this position. Volume in excess of the 50-day average is not you, me, and our grandparents trading these positions, everybody. If you got volume in excess of the 50-day, that is institutional traders, all right? So our 50-day average through here, just to give you an idea, is like 11.5 million, okay? But here we are trading instead of 11.5, we're trading pretty good volume. I mean, we're talking, looks like this one was 12, and then we go forward, you're looking 16 and 20. So we're getting huge moves in volume in excess of average, which is at least helping us to understand that. All right, understanding that smart money is finding this move to be significant, and the breakout and then the throwback. This is, so totally within reason. Even though the percentage-wise, nobody likes to see, the give back like we've had here, because it's basically back 30%. But if you rally 80 or 90 and you give back 30, you're still doing quite well. So monitoring trend, we're waiting for, if we're bullish here, we're waiting for the close above the low of the high day. And right now, as we zoom in here on Enphase, the low day to this point is yesterday. And so if yesterday sticks as the low, well, then a close above the 5150 level today in Enphase would be a lovely development for the bulls to kind of hang their hat on there, right? So that's one thing for consideration there with Enphase. And then I think I looked at this one on the weekly. Let me just toss this back. Well, that's even more interesting, isn't it? You can see we've got a let me clean this back up real quickly just to change our time frame a smidgen. Is the weekly chart in lieu of the daily chart on Enphase here. Draw this trend line through those peaks. Now, does that maybe give you even more comfort, being that we've broken what amounts to, but guys, that is a October 23, almost a 3-year downtrend, certainly a 2.5-year downtrend that has been broken. Now, holding this level could be very significant, maybe a much longer term trend under development than what we were maybe speaking to initially here, right? So that stands out. That is quite intriguing to me. I'm glad we looked at that one on the daily and the weekly both. All right, we've got about 5 minutes to go here, everybody. I've got a few more. Let's take a look at the CME group. CME was upgraded at Keefe Bruyette to outperform from market perform. They left their target price unchanged at 305, stating that the recent sell-off in shares creates, quote, extremely attractive, end quote, risk reward, according to the analysts in their research note. So the firm attributes the sell-off to perceived perpetual futures risk. This is overblown in general for exchanges and CME specifically, according to Keefe Bruyette, given the company's low retail exposure and index licenses and equities products. Keefe sees an improving volume backdrop for the CME, which it thinks can continue into the second half of this year, given the positive views on rates activity. That's a lot of commentary. Now, the trend on this, finding the 100-week moving average here could be significant. The tails could be considered significant as well, because we've come into this 245 zone previous and have held. Now, 3 weeks in a row, it's kind of notable that 3 weeks in a row we've held those levels. And you can see those tails are not small. You're seeing moves from 245 up to closes in the neighborhood of 255. So you've had 10-point swings to below the closing levels. Now, let's take a quick look on the daily. And yeah, there's the level here. Now, also interesting is the amount of selling going on over this. So in the weakness, this might be considered to be a little concerning, but the question becomes, is that selling, is it all selling volume? Yes, the stock is going down, but the reminder is institutions are smart about how they go about making their buys, right? They don't do it in mass. They do it in pieces and in chunks. And our friend Ben Watson likes to always say, when I'm hanging out with Ben in these investor events, our in-person events, his reminder is that you can always see the footprints of the institutional investors in the butter in the fridge, right? The metaphor he uses is, how do you know that you've had an elephant in your fridge? Well, you can see the footprints in the butter, is his comment. And what's interesting to me is the reminder is that institutions have no trouble buying in ugly days and in ugly charts, because they are leaning into their their plan and their process and their belief in valuations as much as anything else. So their analysis is giving some interesting opportunity given the price action we've seen in CME of late. So pretty interesting chart. I wanted to make sure we talked about that one as well. Okay, so let's go ahead and wrap it there, everybody. It's been a busy week for me, probably a busy week for all of you as well. Next week, I'm out a couple of days as I'll get back from Chicago and need to recharge the batteries. So I'll be out until next Wednesday when I'll reconvene with you for Trader Talk on Wednesday morning with our buddy Brent Moores. In the meantime, you will have Brent available on Monday for the Trader Talk session. And of course, Tuesday, my Tuesday afternoon session, Building a Stock Portfolio. Barb has been kind enough to grab that one for me on Tuesday afternoon. Last thing is just to highlight that position we have, Synopsys, is in the example portfolio. I just wanted to point out that we still have that trade. It is going against us, but our planning has left us in the trade, everybody. Look at this. We bought with a belief that we had an improving technical condition. We built an exit strategy that was an average true range below the 50-day, and it has to this point held. We've had lows that have been pretty close, but we've missed it by a buck or two, so we've not as of yet been stopped out. And again, when we're building that trade, because we've already set our stop, we have comfort with tolerance for our risk. We don't need to make any alteration. The key decision now is to leave our initial stop where it is. We can't guarantee the price we're going to get out at, of course, because it's a market order once it triggers, but hopefully what we're seeing is a ledge of support created over the last 7-8 sessions here that will hold and not get us stopped out. So fingers crossed on that example trade. So with that, thanks again for being here. Big thanks to you, Barb, as well. Follow Barb and me on X. Hit that thumbs up button for us below here. We'd appreciate that, of course. And be on the lookout for this one joining the archive shortly hereafter. So have a great rest of your weekend, everybody. I look forward to catching up with you real soon.